Bonds have been around for thousands of years. Though they looked a little different in 2400 BC, they have a similar function in the investment world today. Think of bonds as a type of loan. You loan money to a company in debt by buying bonds from them. In exchange, the company pays you regular interest payments, plus the original amount, called the principal, by a set deadline called the maturity date. The total return you can expect to get if you hold your bond to maturity is called the yield, or the yield to maturity. Bonds have terms that range anywhere from a year to 30 years. If you're looking to access your principal in the short term, you may want to consider bonds with shorter time horizons. If you have the option of investing your money for longer, long-term bonds may be an option for you. Some bonds have specific features you should be aware of. Callable or redeemable bonds let the borrower pay off their debt before the maturity date. This effectively reduces the amount of interest you receive. To compensate you, the interest rates or coupon rates on callable bonds are typically higher. Convertible bonds usually let investors choose if they want to convert their bond into a stock. Investors may want to do this if they think the stock price will be more profitable than the bond's yield at maturity. Before starting to invest in bonds, it's important to understand the risks involved. 4 common risks of bond investing include inflation, interest rate, liquidity, and default risk. Inflation is the rate at which the price of goods and services rises over time. It erodes the purchasing power of money, meaning you won't be able to buy as much in the future with the money you earn today. It's one reason to pay close attention to the term of bonds. Shorter-term bonds may not have as much inflation risk, since there's less time for inflation to fluctuate. But they may offer lower returns in exchange. Many bonds also only offer the stated returns if you hold your investment until maturity. If you decide to sell before the term expires, what you get back depends on market conditions. This is because interest rates may have changed in the meantime. When inflation gets too high, economists at the Bank of Canada sometimes raise interest rates to help safeguard your money's purchasing power, or to encourage consumer saving if spending is causing the high inflation. If inflation is too low, they may try to stimulate the economy by decreasing interest rates to encourage spending. Bond prices tend to fluctuate with the interest rate environment. When interest rates go up, coupon rates on new bonds go up with them, and vice versa. While this won't affect your return at maturity for any bonds you're already holding, it's important to consider for one key reason. If you invest all your money into a bond and interest rates go up, your money is tied up while more profitable bonds are becoming available on the market. Investors can use something called the yield curve to get a sense of where bond prices may go in the future. More on this later in the course. Liquidity risk refers to how quickly you can sell your bond when prices change and how much you can get back for it. As higher interest rates raise the coupon rate on newly issued bonds, demand for existing bonds with lower rates goes down. This is typically important for traders who sell their bonds in the secondary market, rather than investors who hold bonds until maturity. And finally, default risk. In some cases, borrowers run into trouble repaying their debts, meaning investors can lose their principal and any potential interest. It's important for investors to be aware of the insolvency rules and that bondholders are typically paid out before shareholders. However, this is a broad example. There are exceptions to the rules that can change the payout priority level. When you invest in the bond market, the details of the transaction are outlined in a legal document called a trust deed. This document lets you recover your money by using the company's physical assets as collateral. Keep in mind, though, that some bonds aren't backed by physical assets, only by the general creditworthiness of the company. These are called unsecured bonds or debentures. Also note that bonds backed by different issuers carry different risks. As a general rule of thumb, bonds backed by the government tend to carry less risk because there's less chance that the issuer will default on their loan. Corporate bonds tend to have a higher default risk, especially when they're issued by smaller companies with unproven business models. These nuances are typically reflected in a bond's credit rating, which assesses how likely the borrower is to pay you back. Investment-grade bonds are considered low risk. These typically have a rating of BBB or higher. Bonds with ratings below BBB are considered higher risk. Have more questions? Check out the links to the right and in the description below.